Index funds or mutual funds. And a lot of people are talking now that you don't need to be buying mutual funds because they charge fees.
When you look at it in months when the Fed has raised the target Fed funds rate or decreased the target Fed funds rate, it has been about 1% a month.
Mutual fund versus index fund versus ETF stocks. Which is better? When it comes to investment options, there are so many choices. Sadly, though, many of us go to invest thinking we're doing the right thing by saving for our future, but we end up hurting ourselves financially because of hidden fees and the unknown. Today, we want to go deep in sharing with you the advantages and disadvantages of a mutual fund, index fund, and ETF stock. Each of the three has its advantages and limitations that you should be aware of when investing. We'll go over everything important so you'll be ready to make the best choice immediately after this video. Before we help you become the next Warren Buffett, in the comment section below, would you let us know with a yes or no comment if you've ever invested in an ETF stock? Now let's dive into mutual funds versus index fund versus ETF stocks. So to begin with, what is a mutual fund? A mutual fund is a company that pools money from many investors and invests the money in securities such as stocks, bonds, and short-term debt. The combined holdings of the mutual fund are known as its portfolio. Investors buy shares in mutual funds. Each share represents an investor's part ownership in the fund and the income it generates. Mutual funds are popular among investors because they offer professional management, diversification, affordability, and liquidity. Most mutual funds fall into one of four main categories: money market funds, bond funds, stock funds, and target date funds. Each type has different features, risks, and rewards. Money market funds have relatively low risks. By law, they can only invest in certain high-quality short-term investments issued by U.S. corporations and federal, state, and local governments. Bond funds have higher risks than money market funds because they typically aim to produce higher returns. Because there are many different types of bonds, the risks and rewards of bond funds can vary dramatically. Stock funds invest in corporate stocks, while target date funds hold a mix of stocks, bonds, and other investments. Over time, the mix gradually shifts according to the fund strategy. Target date funds, sometimes known as life cycle funds, are designed for individuals with particular retirement dates in mind. A mutual fund is both an investment and an actual company. This dual nature may seem strange, but it's no different from how a share of AAPL represents Apple Inc. When an investor buys Apple stock, he buys partial ownership of the company and its assets. Similarly, a mutual fund investor is buying partial ownership of the mutual fund company and its assets. The difference is that Apple is in the business of making innovative devices and tablets, while a mutual fund company is in the business of making investments. As an investor, there are three ways to earn a return from a mutual fund. Income is earned from dividends on stocks and interest on bonds held in the fund's portfolio. A fund pays out nearly all of the income it receives over the year to fund owners in the form of a distribution. Funds often give investors a choice to either receive a check for distributions or reinvest the earnings and get more shares. If the fund sells securities that have increased in price, the fund has a capital gain. Most funds also pass on these gains to investors in a distribution. If fund holdings increase in price but are not sold by the fund manager, the fund's shares increase in price. You can then sell your mutual fund shares for a profit in the market. All funds carry some level of risk. With mutual funds, you may lose some or all of the money you invest because the securities held by a fund can go down in value. Dividends or interest payments may also change as market conditions change. A fund's past performance is not as important as you might think because past performance doesn't predict future returns. But past performance can tell you how volatile or stable a fund has been over a period of time. The more volatile the fund, the higher the investment risk. Secondly, let's take a look at the index fund. An index fund is an investment that tracks a market index, typically made up of stocks or bonds. Index funds typically invest in all of the components that are included in the index they track, and they have fund managers whose job it is to make sure that the index fund performs the same as the index does. The first step when investing in an index fund is picking an index. There are hundreds of different indexes you can track using index funds. The most popular index is the S&P 500 index, which includes 500 of the top companies in the U.S. stock market. You can also find sector indexes tied to specific industries, country indexes that target stocks in single nations, style indexes that emphasize fast-growing companies or value-priced stocks, and other indexes that limit their investments based on their own filtering systems. The second step is choosing the right fund for your index. Once you've chosen an index, you can generally find at least one index fund that tracks it. For popular indexes like the S&P 500, you might have a dozen or more choices, all tracking the same index. If you have more than one index fund option for your chosen index, you'll want to ask some basic questions. First, which index fund most closely tracks the performance of the index? Second, which index fund has the lowest costs? Third, are there any limitations or restrictions on an index fund that prevents you from investing in it? And finally, does the fund provider have other index funds that you're also interested in using? The answer to those questions should make it easier to pick the right index fund for you. The third and final step is buying index fund shares. To buy shares in your chosen index fund, you can typically open an account directly with a mutual fund company that offers the fund. Alternatively, you can open a brokerage account with a broker that allows you to buy and sell shares of the index fund you're interested in. Again, in deciding which way is best for you to buy shares of your index fund, it pays to look at costs and features. Some brokers charge extra for their customers to buy index fund shares, making it cheaper to go directly through the index fund company to open a fund account. Yet many investors prefer to have all their investments held in a single brokerage account. If you anticipate investing in several different index funds offered by different fund managers, then the brokerage option can be your best way to combine all your investments under a single account. Ultimately, investing in index funds is one of the easiest and most effective ways for investors to build wealth. By simply matching the impressive performance of the financial markets over time, index funds can turn your investment into a huge nest egg in the long run. And best of all, you don't have to become a stock market expert to do it. And lastly, we look at ETF stocks. An exchange-traded fund, or ETF, is a fund that can be traded on an exchange like a stock, meaning it can be bought and sold throughout the day. ETFs often have lower fees than other types of funds. Depending on the type, ETFs have varying levels of risk. But like any financial product, ETFs aren't a one-size-fits-all solution. Evaluate them on your own merits, including management costs and commission fees, if any, how easily you can buy or sell them, and their investment quality. There are various ways to invest in ETFs, and how you do so largely comes down to preference. For hands-on investors, investing in ETFs is but a few clicks away. These assets are a standard offering among the online brokers, though the number of offerings and related fees will vary by broker. On the other end of the spectrum, robo-advisors construct their portfolios out of low-cost ETFs, giving hands-off investors access to these assets. One trend that's been suitable for ETF shoppers: many major brokerages drop their commissions on stock, ETF, and option trades to zero. ETFs can vary significantly when it comes to cost. The range may feel intimidating, but it also means there's an ETF for every budget. It may help to outline how much you're willing to spend on an ETF before you dive in. When researching ETFs, you'll also need to consider the fund's expense ratio or the fee the fund charges to manage and maintain it. Because most ETFs are passively managed, ETF expense ratios are typically pretty low compared with other types of funds. For all their simplicity, ETFs have nuances that are important to understand. Armed with the basics, you can decide whether an ETF makes sense for your portfolio and embark on the exciting journey of finding one, or several. An ETF works like this. The fund provider owns the underlying assets, designs a fund to track their performance, and then sells shares in that fund to investors. Shareholders own a portion of an ETF, but they don't own the underlying assets in the fund. Even so, investors in an ETF that track a stock index may get lump dividend payments or reinvestments for the stock that make up the index. While ETFs are designed to track the value of an underlying asset or index, be it a commodity like gold or a basket of stocks such as the S&P 500, they trade at market-determined prices that usually differ from that asset. What's more, because of things like expenses, longer-term returns for an ETF will vary from those of its underlying asset. Investors have flocked to ETFs because of their simplicity, relative cheapness, and access to a diversified product. But there are some things to watch out for. Some of the advantages are diversification, transparency, and tax benefits. On the downside, investors may experience harsh trading costs, potential liquidity issues, and the risk that an ETF will close. When comparing ETFs with other investments, ETFs stand out in several ways. Lower investment costs, better diversification, and an increasing number of options are just a few of the benefits of ETFs. Generally speaking, ETFs have lower fees than mutual funds, and this is a big part of their appeal. ETFs also offer better tax efficiency than mutual funds. The two products also have different management structures, typically active for mutual funds, passive for ETFs, though actively managed ETFs do exist. And like stocks, ETFs can be traded on exchanges and have unique ticker symbols that let you track their price activity. Unlike stocks, which represent just one company, ETFs represent a basket of stocks. Since ETFs include multiple assets, they may provide better diversification than a single stock. That diversification can help reduce your portfolio's exposure to risk. There you have it, the 3 investment options. Which one would you settle for and why? Let us know in the comments section below.